guys, welcome to my channel. When you are a corporate treasurer and you need to buy 10 million euro tomorrow, you call your bank and ask for a euro USD quote. The dealer gives you two numbers, 1.0848 bit and 1.0852 hash. At first, you might think, why doesn't the bank just give me one exchange rate? Because the bank is a market maker, it is willing to buy euros from you at one price and sell euro to you at another. That small difference is the big as spread, and in foreign exchange, understanding that spread is more than just knowing a formula. It tells you something about liquidity, volatility, trading conditions, transaction size, and dealer relationship. Then it gets even more interesting. If you look at three currencies simultaneously, inconsistent exchange rate walls can create something called triangular arbitrage. That's a situation where, in theory, you can move from currency A to currency B to currency C, ending up with more money than you start with. So, in this lesson, we are going to build the FX market from the dealer's perspective. Let's begin with the basic terminologies. A spot exchange rate applied to a currency transaction that settle in near term, typically T plus 2 for many major currency pairs. A forward exchange rate, on the other hand, applied to a transaction that will settle at a specified future date. So the distinction is primarily about when the currency transaction settles. Now we need one more important idea. An FX swap involves two currencies, the base currency and the price currencies. The world tells us how much of the price currency is required to buy one unit of the base currency. For example, euro to USD equal 1.0850 means 1 euro equal 1.085 US dollars. The euro is the base currency and the US dollar is the price currency. This conversion becomes critical when we are interpreting big as well. Now imagine you are the FX dealer. You don't want the one price, you want two price. The big price is the price at which the dealer is willing to buy the base currency, and the ask price or offer price is the price at which the dealer is willing to sell base currency. Suppose the dealer wants euro USD 1.0848 bit and 1.0852 as the dealer is saying, I will buy euro for 1.0848 dollar per euro. But if you want to buy euro from the dealer say, I will sell them to you for 1.0852 dollars per euro. Notice something for the metal. The ask is always higher than the bid. That difference is what we call the bid ask spread. The calculation is simple. The bid ask spread equal ask price minus bid price. So if the work is 1.0848 bid and 1.0825 as the spread is 1.0852 minus 1.0848, that gives us this. For currency pair work to 4 decimal place that commonly described as 4 pips. But here the more important point, the spread represents a transaction cost component of trading. If you want to buy immediately, you pay the ask. If you want to sell immediately, you receive the bid. So the spread is effectively the cost of crossing from one side of the market to the other. Now this is where the concept becomes much more interesting for investors. Why isn't the spread always the same? Because the dealer is taking risk and the amount of risk changes with the market condition. There are 5 major factors you should remember. First, the currency pair. Highly liquid currency pair generally have narrower spreads. Major pairs such as Euro USD typically trade with very deep liquidity. Less actively traded currency can have wider spreads. Second, the time of day. FX is a global market. When major financial centers are actively trading, liquidity tends to be stronger. More participants are providing quotes that generally means tighter spreads. During quieter period, liquidity can decline and spread can widen. Third, market volatility. Suppose the currency market is extremely volatile. The dealer wants you a price, but the market can move sharply before the dealer can hack the position. That creates greater risk for the dealer. So the dealer may protect itself by voting a wider spread. So higher volatility leads to generally wider spreads. For transaction size, a very large transaction can create more execution and inventory risk for the dealer. So the worst spread may depend on the size of the transactions. A small institution trade and a massive corporate currency transaction don't necessarily receive identical pricing. Fifth, the relationship between dealer and client. Large institutional client with established relationship may receive more competitive pricings. A dealer knows the client trade frequently. The transactions may be easier to hedge, so the relationship itself can affect the spread. Here, the investor interpretation. A narrow spread generally indicates a more liquid trading environment. There are many buyers and sellers. Dealers can hedge positions more easily. Competition among market makers is stronger, and the cost of immediately executing a trade is relatively low. A wide spread tells us a different story. It may indicate lower liquidity, higher volatility, and usual market conditions. So don't look at the spread merely as a number. The spread is information about market conditions. There's another point that often causes confusion. When a dealer provides a two-way vote, the counterparty can choose whether to transact at the bid or the ask, depending on what they are trying to do. If you want to sell the base currency, you transact at the bid. If you want to buy the base currency, you transact at the ask. So don't memorize bid and ask in isolation. Think about the dealer. Bid equal dealer buys and ask equal dealer sells. That mental model is much safer. Now let's move to the more interesting part is arbitrage. Arbitrage is it when inconsistent price creates an opportunity to earn a profit without taking meaningful market risk, assuming the transactions can actually be executed at the world price. In forex market, this becomes particularly interesting when we have three currency because you can move around a loop currency A to B to C and to A. This is called triangular arbitrage. Suppose we have three currency US dollar, Europe, and Germany yen. We can convert USD to euro, then euro to Germany, and Germany back to USD. If the exchange rates are perfectly consistent, we end up with exactly what we start with, ignoring transaction costs. But if the world rates are inconsistent, the loop can produce a profit. That's the basic logic of triangular arbitrage. The key concept here is the implied cross rate. Suppose the market directly vote euro Japanese yen, but we can also calculate euro Japanese yen rate that indirectly using USD. That indirect rate is the implied cross rate. Then we compare the implied cross rate with actual world cross rate. If they are inconsistent, there may be an arbitrage opportunity. This is exactly how professionals think about triangular arbitrage. When testing for arbitrage, you cannot simply use the midpoint of each exchange rate word. You must use the actual bid and add price because every conversion involves either buying or selling a currency, and therefore you cross the spread. This is crucial. An apparent arbitrage opportunity based on midpoint price may disappear completely once you account for bid as spread. So the correct question is not are the bid market exchange rate inconsistent? The correct question is can I actually execute the entire sequences at the world bid and ask price and fit it with more of my original currency? This key the no arbitrary conditions. Exchange rate quote by the dealer should be consistent with the rate applied by other currency pairs. If the direct bid or ask deviates sufficiently from implied cross rate, there may be an arbitrary opportunity. The important word is sufficiently, because the difference has to be large enough to overcome the bid ask spread and any other transaction cost. A tiny discrepancy may not represent a profitable opportunity. It might simply disappear when you execute the trade. Thanks for